Welcome back to Good Returns. I'm Matt here with Garrett, and we're back in the studio, which feels right given the week we need to talk through.
Yeah, welcome back. All tan and...
I am tan. Tan complexion.
Yeah, it's good to be back in the studio. This week had some real substance to it. The winning streak.
Well, you got to. Why am I tan?
I don't know. I mean, I'd leave that up to the viewers.
Not going
They
to
can
the
use their
tanning bed.
imagination.
Went to the Emerald Coast.
Say anything.
The Emerald Coast, the Redneck Riviera.
Okay.
What other terms do they call it?
I don't know. Either one of those will work, I guess.
I think there's another one that's common in the vernacular.
Sure.
Yeah, down to the Destin area. It's nice. A few days. Kids got out of school. It was enjoyable.
Well rested.
Yeah. Water was a little too cold for my liking, but...
Well, it is still May.
Yeah. On the way back, to make matters worse, we stopped at a natural spring where the water is very cold, and I was forced to get into it.
Good.
So,
Give
but
you
it's
a
supposed to be
little,
healthy for you.
Yeah. Increase your fortitude a little bit.
There's no getting used to that. I don't know how people do the ice. Do you do ice plunges? Have you ever done an ice plunge?
No, I have not. I could, but no, I have not. I would like to. I'm not against it. But yeah, it's takes some working up too.
I don't know about that. Anyway, we do have a lot to get into.
Yeah. Anyway, back to the task at hand. You have kind of the winning streak. You know, we've talked about the past few weeks. All-time highs, winning streak. It's not really over this week. I think the S&P is going to end up positive for the week, but not by much. So we'll talk about that. We'll also talk about yields, touching levels we haven't seen in 2 decades. Federal Reserve potentially putting hikes back on the table. We've kind of talked about this before. And Nvidia earnings that were, by any measure, pretty remarkable.
Yeah, absolutely extraordinary. And we'll have a nice planning room conversation today that I think is going to make some people potentially uncomfortable, but in a good way. We're going to be asking a question about the standard 60-40 portfolio that most people advisors are afraid to bring up, afraid to challenge common, what has been kind of the common understanding in the industry, or people may be afraid to really even ask out loud. It's kind of a head in the sand approach. So very interesting.
Yeah, quick note first before we get into that. Everything on Good Returns is for educational purposes only. Nothing we say is personalized financial advice to you. We may or may not be your financial advisors. And so we're here to give you context for things, help you think more clearly about matters that are in the news and planning topics like in our planning room. That said, let's get into the weekly market recap. So we had, like I said, 7 consecutive weeks of gains. And then this week, still kind of in the gain territory, although a little bit less so. We are definitely seeing some concentration in areas. And we talk about the breadth of the market not being as wide as it was a few months ago. NASDAQ traded lower as the tech rally kind of cooled. And you have some advancing it's concentrated to a few names, which is not always great when you see that kind of thing.
Yeah, and some context, when you look at the VIX, which is the fear gauge, it is sitting at levels kind of late January. Definitely not panic, more of a typical VIX move, more of a digestion of the way the market has behaved in the last week. The market absorbed a significant amount of good news over the past 7 weeks. And now, which is typically to be seen, you'll kind of have some sideways action, some processing of what could be more complex unfoldings of events here in the near future. So it's kind of part and parcel what we have seen time and time again repeating itself, especially after
outcomes.
Seven really good weeks.
Yeah, so we have energy and defensive sectors holding up a little bit better than the broad market. Then you have economically sensitive areas like materials and industrials, which were lagging. Bonds declined as those rates continued to climb because of that inverse relationship. And oil had another volatile week, spiked near 110-ish on geopolitical concerns, again, with everything going on in Iran, and then fell back below $100, which is the same old story. Like the negotiations happen. We've got a deal. We don't have a deal, ad nauseum.
Yeah, midweek reversal was sharp. Oil falls, rates ease, and the S&P and NASDAQ, boom, pop. Dow did briefly cross 50. As of today, we're like inching our way closer to 51.
Yeah, good day today.
Markets tracking two variables in real time, oil and interest rates, and reacting to every headline that touches either one. Little caveat there, that again is showing you the stimulus-driven nature of the markets, in that any pickup on any type of stimulus, be it to the consumer or to businesses in lower rates, the market's reacting strongly, which does lead me to game out what happens if we're at Dow 50, oil's back at 50, and we get 50 basis points of cuts, which had been previously priced in at the beginning of the year, kind of the expectations for this year. If we get the three-legged stool of 50, 50, 50 going on here, I wonder what things are going to do. I wonder how the market's going to react to that, because it seems to be any hint of more favorable prices for consumer, which drives greater consumption elsewhere, or favorable interest rates for businesses, which creates expansion. The economy is responding. The stock market, that is responding very positively. And sometimes what you could consider as almost outsized moves just on headlines.
Yeah, I mean, it depends on how the Federal Reserve is going to view the inflation reports that we've got recently. So I don't think we're in a scenario where we're going to see that play out anytime soon. That would be what I would say. Maybe in the future. I don't know about this year. I think we're probably further out than that.
Well, it depends on what the bond market does. Really, yeah. I think at this point, I don't think anything that the CPI is going to print is really going to be relevant to the decision making this year. I think it may, in fact, be led by whether or not the Fed wants to get ahead of the bond market or let the bond market lead, which in the past it has done before.
Well, it's giving some definite signals now that historically the Fed has sort of taken pretty seriously. I mean, you have the 30-year Treasury yield touching 5.19% on Tuesday, which is the highest level in nearly 19 years. To both the 2 and the 5-year, both rose for the second consecutive week. And we saw the Federal Reserve, the April meeting minutes released, made it pretty explicit that some people, as a part of that committee, are even discussing hikes now.
Yeah, you won't see that happen, because then they're going to the yield curve is going to, which I've already said ad nauseum why it's not going to happen, but you're not going to, especially with rates making the move that they made. You can make the argument for be patient. And, we look at what Greenspan did. It was not quick. It was over a period of time that the rates were slowly, methodically brought down. So,
I mean, I think we're still in that.
Yeah, I just don't see hikes coming into the equation simply because there's no reason to do that, especially if the bond market is doing some of the heavy lifting for you, if you are concerned about.
Yeah, so how does the bond market do that? I guess we should talk about that.
The 10-year Treasury drives most of the lending.
Right, mortgages, credit cards,
all of those things, but especially business lending. So the Federal Reserve only controls controls in normal operating environments. They only control the short end of the curve. They have pretty much direct control over anything less than a 1-year Treasury, basically. So 1 to 3 month Treasuries, 6-month notes, et cetera, et cetera. They have control over that environment, but they don't have any control over anything that starts to go beyond that, unless they conduct open market operations where they are tilting the scales in the bond market by buying large chunks of treasuries or corporate bonds, as they did during crisis periods. But buying the treasuries pushes down the rates, and it's a form of yield curve control to an extent. So they do have that. That it appears that even the old regime and the new regime are opposed to some type of expansion or any significant expansion of the balance sheet. So that locks the Fed purely into just controlling the short end of the curve. So the bond market can do a pretty good job of having short-lived moments of constraint within the business cycle. that will react very, very quickly to changing environments. So you can have the 10-year Treasury drop significantly within a 2 or 3 week period of time.
We saw that happen.
Yeah. It's where the Fed may take 6 months.
Yeah.
Or a year or 2 years. So I don't see that occurring. I don't
necessarily see it occurring either. And I'm not going to die on the hill of they're going to hike rates, but I do think that what we will see is probably just nothing. I think we'll see kind of status quo through the end of the year. I wouldn't expect to see any cuts,
which isn't a bad thing, really and truthfully,
right.
because if you can take your time, then that's telling you the economy is strong, and each additional cut as we get closer to probably that 2 to 2.5% is just going to be fuel to the fire for risk assets.
Yeah, and this is commentary that's being made from where we are now currently. There are a lot of things that could change that, and a lot of it could have to do with earnings, or we'll talk about it in a minute, but we're already at high, earnings and high valuations, and if we have a miss one quarter on earnings, could that be enough to set off some sort of multi-layer effect? I don't know, but as it stands now, what it looks like is, they're going to talk about rate hikes, but I don't necessarily think that's what's going to be the outcome. We got 2 more meetings. Is it 2 more meetings or 2 more this year? More than that?
We have June, we have July, we have September, and then we have December. I do believe. Correct me if I'm wrong, but be nice in the comments section if I'm wrong. Be nice. Warsh is in there. He's clear. Rates should be lower. You have to take that as a very powerful signal. We've mentioned several times AI productivity is his main focus as being structurally deflationary. That is not up for debate. That is a commonly understood phenomena as it pertains to technological advancements. This is no different. And so there will be structural disinflationary or deflationary forces that play out that is going to be in direct contrast to the Federal Reserve's monetary policy. Always turns out to be favorable for risk assets, for real estate, for commodities over time. Some commodities, monetary commodities, that is, monetary metals. And I've made the comparison several times. You will begin to see this in the headlines. You're not seeing it now, but you will absolutely, I guarantee you will see he will be compared to Alan Greenspan, because the parallels are there, they're real. And the difference this time is the internet was increasing productivity, but there was a lot of bubbles and a lot of fluff because there was a lot of nothing there with the dot-com boom. Simply creating a website made a company worth $1 billion. There was nothing there. There was no products. There was no money. There was no revenue. There was no infrastructure in the ground. This is different.
Well, I think there was the earnings also, like legitimate earnings.
There was no earnings then, and there are.
But I mean,
earnings.
a lot of people bring that parallel to the 2000s, where we are now, and it's just because of valuations, and it's just because, there are legitimate concerns we've talked about it before, but when you have companies like Allbirds, it's a public shoe company, and they pivot to make AI, and then their stock price is up 1,000% in one day. I mean, that is not normal.
That is not normal. But when you look at the big players that have the real, for instance, the Allbirds example, while valid, Allbirds is worth a rounding error to the money that these other companies are making. You sent me something over the week. Yeah. And so do think of that.
Anthropic is going to pay SpaceX $1.2 billion a week or something like that. A month. Okay.
For 3 years.
Yeah, that's the contract through 2029.
This is a company that is not yet public, but is obviously making so much money.
As of now, they will be shortly.
That they signed a 3-year contract to pay SpaceX for data $1.2 billion a month. That is unbelievable. So I was speaking to someone while on the beautiful white sands
of the Redneck Riviera
of Florida. Yeah, it's amazing. There's really nowhere else. Very, very few places on planet Earth you can go with white sands and that clear of water. And there's a lot of people, but I think most of the country really hasn't even discovered it. I mean, there's millions that go, but like nothing compared to what it could be. So we should probably edit this out so less people are aware.
Let's give the exact place you stayed and GPS coordinates.
So in speaking with somebody, it's like, do you ever think like, because a lot of like Anthropic, they're going to go public. They'll probably IPO at $1 trillion.
Oh, Anthropic was the one you were talking about. It's not public.
Yeah, Anthropic's not public.
Okay, I thought you were talking about SpaceX.
Well, that too. They're going to be. They're going to be like what 1.82 trillion, 1.82 trillion. It's like, do you ever think there's?
Are they in a June? They're in a June IPO, like June 16th or something.
Coming
like
up soon, yeah. Is there any opportunity for like the regular guy to get involved? And it's like, yeah, there's always opportunity because these things are going to IPO. They're going to be big. And they'll probably go up more, but there's always going to be opportunity. There's going to be corrections. There's going to be. That's why the dollar cost averaging makes so much sense in your 401k. In your managed portfolio, if you're in that accumulation phase, you're going to have exposure to all these things inside your ETF strategies or inside your single stock strategies. And I don't really worry too much about trying to be the first because you're going to have plenty of opportunities and your 401k is going to benefit just from having exposure to the different funds and indexes that it's in to these. So I don't think when you have people, the average person asking, when am I going to have a chance to get involved in some of the AI stuff? It's early innings.
Well, I mean, you already are. If you own the S&P 500, if you own an S&P 500 equity fund in your 401k, you're participating in Nvidia.
You're
Tesla,
you're overweight.
Amazon,
you're
Apple,
overweight
Google.
Nvidia and Google. If
So,
you're in the standard,
you already are to a certain extent. But to your point, like IPO, that's going to be a big question. How can I get the SpaceX IPO or how can I get an Anthropic IPO? And I would say the answer is time. I don't think that you should be beating down the doors to try to get in at the first.
No, I favor time with IPOs. I have private equity. I've had some private equity in the past. Most of the time, if you're not an early investor in these companies, or you're not an employee with stock options, you're right. The best thing to do is just wait, be patient.
Does that Barron fund have SpaceX in it?
Barron still has SpaceX. A decent amount of exposure. There's a few other funds. There's also some other publicly traded equities that over a third to a half of their market cap is actual SpaceX stock, believe it or not, through deals that have been made. So there's different ways you can get creative about it, but being patient and time is generally best because when something IPOs, you have to keep in mind after a 6-month period, those people can sell.
Right.
And you have a lot of people that's been involved at SpaceX since 2003.
Yep.
And
they're getting private shares.
It's time for them to have a liquidity event.
Yeah.
And so they're going to be selling because they're probably, you got to think if you've been there 23 years and you switched mid-career to work at that company, maybe from NASA or another private defense contractor or something of that nature, you're getting ready to retire soon. You want...
Has SpaceX been around that long?
Yeah, 2003, I believe. It was the first company after PayPal that they worked on.
Wow.
Musk and those people, yeah.
2003.
Yeah.
Interesting.
Yeah, it's been around a while. So very interesting. And we can do...
Well, I think the Claude and SpaceX relationship is going to continue to be extremely interesting. You had Elon actually visit the Anthropic headquarters, and he said he was very impressed by what he saw.
Who wouldn't be? If you've used it, it is impressive.
It is impressive.
It's not perfect, but I will say.
It's not perfect. But it is, I'm seeing more and more people in the wild when I go places and they have their laptops open. I'm seeing more and more people pulling up Claude rather than ChatGPT. I think ChatGPT used to be the default, and I don't think that is the case anymore. And I think Anthropic was having a serious issue with limiting because you used all your credits or your tokens or whatever they call it. And I think that almost immediately, at least in my experience with using it, there was a shift when they announced the deal with SpaceX. It was like, I'm not getting nagged. I can finish a session or whatever. And it was working out well. So I think that they are seeing that too. And that would be one to watch. And then you have OpenAI. One of the co-founders of OpenAI actually joined Anthropic last week.
Yep.
And so that is going to be an interesting story as it develops, the relationship between these two companies. And if there is anything that's going to come of Elon having Grok and having a relationship with Anthropic or whatever it is. I'm not alluding to anything, but it's just going to be interesting to watch. Or XAI, really, not necessarily Grok.
I know several people that have started using it. My only complaint is the lack of web interface, unless, like we were talking before the thing, unless you're dealing with extensions, which can not be ideal in some scenarios. But I've used it to correct code for certain things I'm working on that it picks up where the others, they just didn't catch it, and it knows. So it's quite impressive. I've got some friends that have been using it that do some very significant data analysis, and it's impressive. And so that's where I would push back a little bit as we get back on track here. That
is there a track?
Some market participants are absolutely getting ahead of themselves on a few of the commentaries concerning rate hikes. The direction of rates definitely over the next 2 to 3 years, we all hold the belief that they will be going lower, but the timeline may have slipped, and that's fine. In fact, it may be better. It may absolutely be better that they lower rates slower. So, we're definitely not going to take bets this year. I still think one is in order, but we'll have to see. And paradoxically, as crazy as it is, and it's just the nature of the beast, oil may drive that, and I don't think that it should. But for things we won't get into, I think that it is convenient to use that as an excuse if and when oil does come back down to what most analysts think it will be within the next 10 to 12 months. That may be the catalyst that the Fed feels like they can cut without a loss of credibility. So that may be where that one cut.
Yeah, I would hope it didn't take that long, but I tend to agree.
Comes into it. But let's talk about Nvidia.
Nvidia, we talked last week about the AI CapEx conversation with the spending, which is at absurd levels. But Nvidia reports roughly $81.6 billion in revenue for the quarter, up about 85% from a year earlier. Strong earnings, stock buybacks. It's kind of hard to wrap your mind around.
About 15 years ago, and this was influenced by the consumption of financial media, which I've always read. But I'd say maybe 15 years ago, I bought in to the idea of something being overvalued. And the number would get large and big, and then people would say, well, that's crazy. But it's really, it's a backward looking assumption to think that something's overvalued. So I no longer, and have not for a long time, ever held the view that something is overvalued, because the market is pretty efficient at picking up on where things are going to go, and pretty and when the skeptics and the critics take hold, or the short sellers take hold of a name, to me that's the most short-sighted thing, because they're betting on the narrative staying true. And a lot of times when you're shorting something, you run the risk that that narrative is going to flip, and you can rally retail around it. You can really galvanize the leadership around that company to prove you wrong. And then you're betting against the human spirit, which is a hard thing to do. All that being said, when we say these numbers are big, it's coming from, I don't take the view of things being overvalued. Sure, it can happen, but when you see, Apple worth $3 trillion, or you see Tesla worth $1.5 trillion, and people think these are big numbers, it's like, yeah, but the market is huge. Like, do the math, like run it out on an Excel sheet, build in some assumptions, and you'll see, if anything, they're undervalued. It's quite significant, but these numbers are huge. $81 billion in 90 days was NVIDIA's revenue. It's definitely one of the most remarkable reports ever seen. And it shows you the demand for the AI infrastructure is not slowing down. It's not staying the same. It is accelerating.
And this goes hand in hand with the CapEx spending. What you would have to see, this is the other side of the equation to that, the earnings versus the spending. And it is positive for future results. The problem, it's kind of a double-edged sword, because you have to keep growing. And if you have a quarter where you miss, or you don't hit exactly where they want you to hit, is that going to be not fun.
That's going to be your buying opportunity.
Yeah.
Yeah, and it will come. I don't think we're there. I think we're 24 to 36 months out from that, simply because the demand for these data centers is insatiable. It is gigantic. It is huge. You'll see a building being built. We have mentioned several times, beat a dead horse. The one near Monroe, Louisiana is gigantic. The one they're building in LaGrange, Georgia, and then they're building another one about 30 miles away. The one that they have proposed to build in Columbus, Georgia. The ones all around Atlanta, in Texas. They are huge, ginormous facilities, and it's like this much of meeting the demand. The demand is like this, it's the fish you caught that you lied to everybody about and said it was 4 feet long. That's the demand, and all that's been actually completed or is on the docket to be completed this year is the actual size of the real small fish you caught. It's real tiny.
Yeah, I wonder though if that is like, I don't know. I wonder if that's like something the companies really kind of secretly want. They want you to get on one of these LLMs and use up all your credits and have to, either extend your credits, you buy more, or you wait 24 hours or whatever. You wait 3 hours till your credits reset. If that's like the demand is there, I mean, very clearly it is, because there's a lot of people using it. That's why, you get peak times where it's basically unusable. It's because, they just can't keep up with the demand. So I wonder if that's like, I mean, I'm sure they want to service as many people as they can, but secretly, like if your product offering is in such demand that you have to kind of throttle who can use it, is that a good thing?
I don't know. It's interesting. I think more along the lines of, because competition will take care of that with the throttling. So you'll have a player that'll come up and won't throttle. But I think that...
that's not the only part of the competition. You could have that, but the product itself could be worse, which is why it doesn't have to be throttled.
Yeah, and I think because accuracy demands a logarithmic increase in compute power, not a linear. I think to go from of 80% accuracy to 85% accuracy is not, what would that be? Let's just say out of 100, a 5% increase in accuracy may require a tripling of compute power. So I don't know. I haven't looked into that, but I would guess that to get from 80 to 98% accuracy may require an order of magnitude more compute power.
Yeah, it's possible.
So that may be where some of it is going. But let's look at this rally that is still intact. Quick note here on the broader market picture, because context does matter heading into the planning room. S&P is near all-time highs. Stocks at the index level are holding up. Definitely not a broken market at all. Very interesting to see.
Yeah, narrowing, which we already talked about, but it's a narrowing market. Got the largest technology names tied to AI, man, I can't talk today, are doing most of the heavy lifting. Interest rate sensitive areas are kind of feeling the pressure of those higher yields. So, are we going to continue to see the rally becoming a little bit more selective as the rate environment gets more complicated? That's a story that will be in development and we'll watch closely.
Yeah, we see, though, these equity markets are definitely resilient. The case that they have made time and time again for being the best place in the world to compound and grow wealth over time, that thesis has not changed. Definitely what has changed is the bond side of the portfolio that it's operating in, and that is exactly what we're going to talk about in the planning room. And we should have music that transitions us into the planning room.
We'll think about that. We'll work on that. Yeah, let's hop into the planning room. This is going to be an interesting conversation. A lot of people, have heard of the 60-40 portfolio. Do we think that's true?
Oh yeah, I mean, yes, I would think 60-40
kind of a moderate,
portfolio. Yeah,
middle of the road.
60% stock, 40% bonds. So it's a lot. Well, let's talk about the 40% side of the portfolio first.
Yeah, so those are the bonds.
So why would we own bonds?
So bonds in a portfolio, that's supposed to be the balanced part of the portfolio. This is a classic framework of the 60-40. foundation of most retirement portfolios. A lot of target date funds will be in this area if you're, looking at retiring in the next few years. The stocks provide growth. The bonds ideally would provide some sort of stability. And when stocks fall, bonds are supposed to hold their value or rise actually to kind of counteract that. And they sort of act as a ballast to sort of smooth out that ride when that portfolio is working the way it's supposed to be working. Problem is when it doesn't work the way it's supposed to work, which we saw recently.
Yes. Generally, like as you're alluding to, the relationship between stocks and bonds has really held up for quite a long period of time, really until 2022. That was one of the worst years for the 60-40 portfolio in modern history. Stocks fell significantly, but instead of bonds providing that safety, it did the exact opposite. Bonds fell. Some of them fell more than stocks fell.
Yeah, almost parity across the board, really.
Yeah. It was a brutal time for target dates, and it was a brutal time for unmanaged 60-40 portfolios.
Yeah, and the large reason was interest rates. So when the Fed started raising rates aggressively, we talked about how they did it in an order of magnitude more than it had been done thus far. They were having to fight inflation. Bond prices fell because of that, and existing bonds became less valuable because they're issuing these new bonds at higher rates. The faster, more aggressively the rates rise, the harder those bonds get hit. And in 2022, again, we had the rates rise very fast.
Yes, and that brings us to today a little bit. We have what could be the potential setup for some similarities pertaining to the bond market.
Because, yeah, very, very clear that we're talking about the bond market.
Yes, not the equity side. Yeah. So the equity picture is extremely different from 2022. The bond side, with the 30-year being over 5%, it puts you into a situation to where do rates go higher,
right,
or do they fall back down? What that really means is, does the bond portion of your portfolio lose value if rates go up, or does it gain value if rates go down? Because that is the way bond markets work. Rates go up, your bonds are worth less. So if there's a pause or a where we're at now for longer versus hikes versus cuts, that affects the fixed income side of the portfolio, and it doesn't always work simultaneously. You could have the long end, the longer duration bonds will go down, and your shorter duration may go up, or vice versa.
Right.
And well, I don't want to get ahead of myself, but
go ahead.
Yeah. So, okay. This is what investors really need to understand about how the bond prices work. And just to reiterate this, when you see interest rates, or what are commonly referred to as yields, go up, the value of all the bonds previously issued go down. The longer duration, or the longer term, so that's where your 10, your 20, and your 30-year terms come into, the greater the fluctuation to the downside or the upside, the more sensitive it is to rate changes. So a 30-year bond that is at, say, 5.20%, and rates go to just 5.5%, has a very different value change than a short-term treasury. So that's the kind of lays the framework of why you have these inverse correlations between the value of what you hold and the interest that new bonds are paying.
So looking at the real world portfolio value of that, the first question maybe to ask is, what does the bond allocation in my portfolio do? What does it look like? Are we weighted toward longer duration bonds? Do we have some intermediate? Do we have some long-term? Do we have some short-term? Are we kind of spanning the gamut? Do we have corporate bonds? Do we have treasuries that are most exposed maybe to further increase rates? Or are we positioned just strictly in shorter duration instruments that may be a little bit more protected against that?
Yeah, but a shorter duration is definitely more friendly in a rising rate environment. The flip side, longer duration is more friendly in a falling rate environment. So right now, we're like right in the middle.
Yeah, we're straddling the fence.
We are right in the middle of it. So the yields moving from where we are today could drive decisions on how the fixed income portion of the portfolio needs to be managed.
And sometimes that means that you really just want to take a step back from the bond world at all. And that doesn't necessarily mean taking the 40% and putting it with the equities. That means maybe you take the 40%, or maybe you take 25% or 30% or some percentage that you come to an agreement with, a professional that you're working with, and you set aside that in cash or something like a money market fund or something that's earning a little bit, but that's not going to be exposed to the potential downside that a rate hike would bring. Again, we're not necessarily thinking that a rate hike is going to happen. It's on the table from the Federal Reserve's own mouth. But it is something that we have to acknowledge. Like if it's a possibility, if we consider the possibility, we have two outcomes. One is that rates go up. The other is that rates go down eventually. And so what are the outcomes on your part of your portfolio that's supposed to be stabilizing your returns?
The Feds can only control the short-term rates. So the longer-term discussion here of the longer-term rates really ultimately comes down to what is the market pricing? What is the global fixed income market looking at? And so, we're definitely not saying that you should never own bonds or you should get out of bonds entirely. Bonds still serve a purpose. Fixed income still belongs in a diversified portfolio, but it has to be managed, and most advisors do not do it because it's boring. They think it's quote unquote safe, and they just have 40% and they never touch it. They never do anything with it. It has to be managed. It has to be rotated, and the allocations have to be massaged just like the equity side of the portfolio. That is what we do. Now, if you're not experiencing that, this could be a great opportunity to have a discussion with your advisor or to go to momentumwealth.us and speak to us about what's our current outlook, what's our current allocation with bonds. Nothing may need to be changed. But at some point in time, it absolutely will need to be changed because we do not treat bonds as dead money. Most advisors treat it as just dead money. That's your stabilizer. That's your 40%. You may make a little bit, but just forget about getting any type of growth on it. We know there's opportunities with proper management to get returns out of the bond market. There are
or get out of the bond market altogether,
or to say yes, we're going to hold cash, which in 2022 we did. We held short-term treasuries in cash, and we were able to shield portfolios from a 20 to 30% drop of what they thought was a safe fixed income asset. And so anyway, you need to have a conversation. If you're holding them in your 401k, if you're holding them in your IRA or in your brokerage account, don't take action. Reach out to someone and have a conversation. And because my spider senses, or as they say, your spidey senses, are telling me most likely the trend we experienced last year will continue this year in the bond market. But you have to pay attention to the data, and you cannot trust those assumptions. And if the data is telling you, let's go shorter end, let's go intermediate,
right?
Let's focus on 7 to 10 year maturities so that we can still target the percentage return we need to keep that income flowing at a higher rate than what you'd otherwise get. We're going to pay attention to what the data says. But you need to definitely be having a conversation because your bond money should never be considered dead money.
Yeah, I mean, you look at something like, like an ETF, a bond aggregate ETF. You're down about 1.5% year to date. You look at a short-term Treasury ETF, that dividend yield is almost 4%. So, I mean, that's a real gap there that is noticeable, and that should be, cause for a really good conversation with someone that, about your specific situation. So if you haven't had a conversation with your advisor specifically about the bond exposure in the last probably 4 to 6 months, given what rates have done, especially, that conversation is overdue. It's time for it. Ask about duration. Ask about what the allocation looks like if rates rise. Ask about what it looks like if rates fall. Mm-hmm. Those are the right questions to ask right now. You brought up the 401k, and I want to expand upon that because in workplace savings accounts, typically you don't have the options that you do outside of that for bond exposure. You may have a stable value fund that's more cash oriented or short-term treasury oriented. A lot of 401k funds we see have some sort of TIPS like inflation protected security or inflation protected that would substitute there for like a core bond or something like that. That's an important thing for your advisor to look at. Your advisor should be helping you allocate those 401k funds, because for a lot of people, those are the biggest funds they will have going into retirement. So if they're not looking at those, if they're not providing recommendations for those, that is something that you need to really, everything needs to be working together. It needs to be on the same page, because ultimately it's all going to go to provide you a successful or a non-successful retirement.
Yeah, absolutely. And if you keep things static, you're going to miss out. And that missing out is going to translate into less income for your retirement. And we don't want that. And I think at the end of the day, to wrap this show up, talked about a lot of things. The main thing to take away is pay attention to your fixed income positions. Have a conversation. It's free to have a conversation with us. Reach out to a trusted advisor if you don't have one. And if it's not us, reach out to somebody, have a conversation. Get some clarity. The equity story is definitely intact. Earnings are very, very strong. And AI spending is accelerating, which, I guess that's going to be the gift that keeps on giving. The economy is definitely holding strong. That's great for those getting near or entering retirement. But definitely it's a market that's worth paying attention to. You have a lot of investors asking questions, and that is also a signal that a lot of the bubble talk that took place last year is really not relevant. When you have investors paying attention more and more to more subtleties, more nuances, having a willingness to question assumptions, that's a good, healthy thing to see, where we're moving into that show me phase now, which Nvidia did in fact show us. So it's just, you got to make sure that your portfolio is durable, but it's also attentive to all of these developments so that you can constantly be positioned and repositioned for success.
Yeah, the investors who do that work, who ask the right questions, who revisit assumptions when your environment changes, those are the ones who don't typically get surprised during any kind of environment that we run into. So very important note.
Yeah, well, that's good returns. That is.
Yeah, takeaway.
It's a wrap.
Definitely ask questions about bonds.
Yeah, thanks for spending time with us. It's a great conversation. I find all the information as we discuss it week to week very useful. Very useful for me to make sure that we're paying attention to the right areas that need to be paid attention to. We also hope that it leads to great outcomes for all of you. Subscribe if you haven't. Share it with someone who would find value in it. And as always, we will see you back here. You will hear us or see us next week.
Yep. Take it easy. We will see you later. Bye-bye.